Attendees are in listen-only mode.
Good morning. Mic test, mic test. Okay, we're going to start our morning webinar. We'll start off with the Singapore banking sector. Okay, we have upgraded the Singapore banking sector from underweight to neutral. That's because of the improving economy, and we think that this improvement is sustainable and broad-based. So the better outlook is positive for the loans volume and rate dynamics. And when we talk about this volume and rate dynamics, it means is that when loan volumes pick up, we will not see rates going into a negative growth. So we will have growth in volume, loans volume, as well as some rates pick up. But second part would be the competition for the Singapore-based loans. We think that the competition will be is actually more international now, and that would limit the sensitivity of the loans books to rising benchmark rates. And thirdly, we believe that the banks will be increasing their dividends because the CET1 ratio hurdle is at 6.5%, and there's the bank CET1 ratio now is about close to 14%, which is there's a huge excess there. And as we begin to see that there's a potential for the banks to go into negative enterprise value, and what we mean by that is that the return on invested capital for the banks are lower than its weighted average cost of capital, which means is that if the banks are not able to reinvest their capital at a higher ROC than this WACC, then it's better off that they return some of this capital back to the shareholders in the form of dividends. Then for DBS, we upgrade from reduce to accumulate, target price 21.45. We did that because we believe that DBS will be in the best position to compete because of its highest CASA ratio of 91% and the largest deposit base of 342 billion. The high CASA ratio means is that their cost of funding will be low, and they will be able to compete effectively on the price. And for OCBC and UOB, they have a strong wealth management franchise, and that would give them a strong value proposition to the market. For UOB, we maintain reduce because it has the weakest wealth management franchise amongst the three banks and the lowest CASA ratio of 44% with the lowest deposit base of 260 billion. So let's take a look at the guidance, consensus, and results. The results has outperform the guidance and consensus. That's because the first half of 2017 has seen loans growth pick up tremendously as the economy has improved. The net interest margins remain in line with guidance and consensus, and we believe that moving forward, the net interest margin should be range bound as loans growth will be the main driver for net interest income. The allowances has been slightly higher than the previous. Okay, I would say that the first half of the allowances appears to be higher than what was guided before. For DBS is 854 million, forming 82.6% of the guidance, full year guidance, and we believe that this allowances may be a bit higher towards the end of the year, as the risk of higher NPL of elevated NPLs coming in from the oil and gas sector. But we will not expect any lumpy NPLs coming in, as those episodes have been behind us. So all in all, the NPL would be stable, but what we are more concerned of is as the oil and gas sector has been going through this difficult period for a very long time, So what we could see this year and probably next year would be more write-offs as the prospects of recovery in this sector remains poor. So taken together, the elevated NPLs plus higher write-offs would probably impact the allowance expense in any given quarter. This is, of course, considering the fact that the bank's now coverage ratio now is low at close to 100%. So that is a part which we believe is slightly more volatile. So to put in perspective, if any probably if in any given quarter allowances were to go up by an extra 100 to 200 million, that would probably affect the that quarterly total income by about 3 to 10%. So how's the bank's share price versus the SIBOR? So the conventional thought is that the higher SIBOR rates are beneficial for banks, but we argue that the conditions in which SIBOR rises is actually more important. So you can see in the third quarter 15 to the first quarter 16, SIBOR rose sharply, but the bank price declined sharply as well. So we have to overlay it with some of the macro conditions then. Macro conditions were volatile. There were capital outflows from Asia. And of course the economy was weaker then. So increase in interest rates then was corresponded with declines in loan volumes. So that is what I would be alluding to when it comes to weak loans and weak loan volume and rate dynamics. So as we moved into late 2016 to early 2017, we see that the volatility has declined, economy has picked up, and you can see the share price move up despite the fact that SIBOR has not gone past its previous high of 1.2%. So as for the wealth management income here, we show that DBS and OCBC have a larger increasing portion of their total income coming from the wealth management business. We have not included UOB in it because UOB does not disclose their wealth management income in full detail. So as for DBS and UOB, you can see it's trending higher over the past quarters. UOB has OCBC has a larger portion of wealth management income because of its businesses in Great Eastern Holdings and Lion Global and the Bank of Singapore. So when we put that together, the contribution is the highest among the three banks. Then we look at the performance itself. DBS has performed remarkably. We can see that besides the growing AUM, we can see that the yield on its AUM is also rising, which shows that it is defying deflationary pressures. They are still growing the business accretively. Then for Bank of Singapore, we can see that the AUM has jumped in fourth quarter 16 from the acquisition of the ANZ, and its wealth management income is growing higher. For OCBC, the positive takeaway from there is that given the Great Eastern Holdings and its Lion Global businesses, there's a lot of synergy that can come into this segment of wealth management. As for UOB, the second quarter AUM is only at 99 billion. It's lagging behind these three banks. Our gripe on this, on their lower wealth management business, the lagging wealth management business, is that if we move into the second half of this year and next year, given the competition from international players, we find that they don't have this wealth management segment to help them create a niche market for themselves. So they will have to find various other strategies to overcome the competition. And here's the what we talk about on the elevated NPLs and write-offs and the low coverage ratio, and this would cause some volatility to its allowance expense at any given quarter. So although the NPLs are expected to be stable, but the coverage ratio is still at a historical low. As you can see from DBS, they have sold. Recall that they have sold the PwC building for a profit of 350 million to bump up the coverage ratio to above 100, close to 101%. But in the second quarter, because of the elevated net NPL formation and the write-offs, the coverage ratio is back to 100%. And as for UOB, the coverage ratio is the highest amongst the three banks at about 114%. That's because the exposure, UOB's exposure to the offshore oil and gas sector is the lowest amongst the three. It is at about the exposure is about 3.7 billion compared to the other two banks, which is in between 5.4 to 5.7 billion. So here's the GDP growth forecast for the Singapore Bank's three key markets, Singapore, Malaysia, and Hong Kong. You can see that the early part of 2017, the GDP forecast has increased. And here's the net interest margins for the three banks. The net interest margins are trending at range bound and is still lower than what it was back in the third quarter of 2015 and the first quarter in 2017, first quarter of 2016. So we do not expect the net interest margins to revert to this to its recent high, as the loans growth will be the main driver for this net interest income. And here's a chart comparing the net interest income and the loans growth for the three banks. You can see that the second half has been, net interest income has been led on by loans growth. Then we look at OCBC. You can see that OCBC is of the three banks is the most sensitive to interest rates. In the third quarter 2015 to first quarter 16, you can see that the net interest income has declined tremendously as the rates came down. Moving ahead, because of competitive pressures, we think that the OCBC's net interest income may be less sensitive to the interest rate increases. And here is a comparison between across the banks across the banks between two periods. So we have some of the home rates that we had in our records before December 2016, and we compare them with the home rates that we have now in September. So we specifically chose to use the fixed rate because now the fixed rate is as you might recall, is actually the packages that the banks are pushing out aggressively. So one of the things we would like to point out is that in 2014, DBS had introduced the fixed deposit home rate package, and at that point in time, the SIBOR is actually at the trough, is at the low, and that means is that the DBS's home rates would be less sensitive to the uptick in SIBOR, and now as we can see that the SIBOR is moving up, it's an uptrend. All the banks are coming together and they are pushing for fixed rate, which makes them even more insensitive to rising rates. So this is the kind of competition that we are seeing on the ground now. And at the moment, DBS no longer offers SIBOR-pegged mortgage loans. So all their rates, all their home rates are now pegged to the fixed deposit home rate, and the take-up rate is 90%. And next will be the excess capital build-up and the negative enterprise value. So as I mentioned earlier, the regulatory hurdle rate is at 6.5%. The bank CET1 ratio is at 14. And you can see currently now that the negative enterprise value is forming. And as I mentioned earlier, that the net interest margins are expected to remain subdued, and net interest margin is actually an efficiency ratio. If efficiency is lower, we will expect that the return on the invested capital outlook will also not be as optimistic. So given that, we feel that if the banks cannot deploy the capital at the ROIC above the WACC, then it is better off they return it to shareholders in form of dividends. And here, you just take a look at the some of the market share across the Singapore banks' key markets of Hong Kong, Malaysia, and Singapore. And here, the first slide will be Hong Kong. DBS and OCBC experience compressed net interest margins in the first half because of the low 1-month HIBOR. But towards the second quarter, you see there's some uptick. So there's more optimism of slightly higher net interest margins moving into second half. If you look at the market share, we find that HSBC and Bank of China have been the most aggressive in their loans growth. HSBC has the largest plurality in the market, growing from 30% to 32% from 2015 to first half of 17. So the HSBC we believe that HSBC is not just a strong competition in Hong Kong, but also in the Pearl River Delta region, where it's ramping up its presence aggressively. Then in Singapore, DBS and OCBC have, on hindsight, did the right move on acquiring the ANZ's wealth business, Barclays NAB wealth, Asian wealth businesses. That's because we believe that the international players such as BOC and HSBC, after being aggressive in Hong Kong, they could set their sights on Singapore market. As you can see, the HSBC hasn't been really growing market share in the first since 2015. So we believe that second half of 2017 and next year, we would see them come back with a lot more aggressive. And it's also the same for Bank of China. And in Malaysia, the market is a lot more fragmented. The potential mergers of the top Malaysian banks had failed to go through. So the market continues, it doesn't have a few players with that plurality. So we expect the Malaysian markets the competition in the Malaysian markets to continue to be more volatile. And here's the peer comparison across the key markets. The net interest margins of the Singapore banks have been lower than that of the Malaysian peers and the Hong Kong peers. But the NPL ratio is still lower than that of the Malaysian banks. The Malaysian banks would be struggling with a little bit more on the NPL side of things, and perhaps some of the growth prospects are also lower. And next we have the global macro strategy. Citing will be bring us through the discussion of the US dollar weakness and the gold, and how gold would play out with the weakness.
Hi, Mike, guys. Starting here, we'll touch a bit on the dollar weakness and how it helps the gold pricing. As you all know, I think just a few months ago, our technical analysts actually came out with a report which rehash exactly the topic of today, which is the dollar weakness and the and how it benefits gold. So we'll go into more details in terms of the fundamental aspects of this. So just to recap, what does the technical report says? We believe that the dollar has actually hit the cyclical top somewhere in January this year, and we expect there'll be at least a 30% downside to go. So today we will cover a bit on how do we think that the global fundamentals are actually helping out this thesis. So this is our main gist of the story. So we believe that contrarian to what the market expects, when the Fed raises the rates, we believe that the dollar will continue to weaken. What forms our belief generally is actually two main points, which is the over leverage within the US economy. Debt overhang in the private sector will actually limit future economical growth via any form of credit expansion. And of course, we all know that the Treasury debt itself, the Treasury itself is also highly leveraged, and the debt ceiling impasse, which have been postponed somewhere to December, that will potentially cause a re-rating of the US Treasury by Moody's. If that happens, that's actually the second time it happens. This is the second largest rating agency to downgrade the US Treasury. And of course, with any weakening dollars, we see it as a positive sign for gold. Gold will continue to rally past its 2016 high. Main two reasons is actually we find positive sentiment within the investor for interest from the investors, as well as central bank accumulation. We will touch on all these details in the next few slides. So going on to our belief that the dollar won't strengthen in a tightening monetary policy regime. As you can see, history does prove that. It's quite indicative from the chart. You can see that during all the gray areas there shows tightening monetary periods, and the blue color line is actually your US dollar strength, nominal trade weighted US dollar. You could see that during monetary tightening period, dollar does not necessarily strengthen. In fact, what we find more compelling is that the dollar correlates more with aggregate saving and, of course, the confidence of the current administration. So main weakness of the dollar actually lies within the loss of confidence. Like any other currency, confidence plays a very important part in determining the value of the currency. And as of today, what we know is that the US has never been that leveraged in any point in time in their history. So on the left-hand side of the chart, it actually shows us the total household debt, which have actually surpassed its 2008 high. This is something that's quite significant because this essentially tells us that there was a bit of deleveraging done after the global financial crisis in 2008. Subsequently, it has the household have actually continued to accumulate debt. On the right-hand side of the chart, it actually shows us the national debt, which is the public debt, the government debt, and it's now surpassed 20 trillion after the debt ceiling was raised once again this month to actually help facilitate the aid to the Hurricane Harvey. So if we were to do more in depth, when we look at household debt, we know that there's a debt overhang for the American household. What's different this time around is that instead of mortgage debt that has been actually increasing, we see auto loans, student loans, as well as credit card debt that have actually reached an unprecedented record level. And unlike the mortgage loan, such debt do not have collaterals. So your mortgage loan, you have your underlying house as a collaterals, but for auto loan debts, student loan debt, as well as credit card debt, we know that there's no salvage value in that. So in times of default, essentially you get back nothing. So we understand that this debt overhang will handicap US dollar from expanding their economy via any form of credit expansion. And for the national debt, what we know that any possible the debt ceiling will actually cause an potential downgrade. Although like earlier mentioned on, the negotiation has been postponed to December, and Moody's have actually threatened to downgrade it if any form of bills to renegotiate this debt ceiling fails. And as earlier mentioned as well, when Moody's downgrade, it will be the second large credit agency that has downgraded the US Treasury after the Standard & Poor's actually downgraded them somewhere in 2011. So the next point we want to make here, why we feel that the dollar is actually going to weaken, is actually has a lot to do with the confidence within the current administration, which is the Trump's administration. And we know that the stability of a nation can usually be inferred from the political powers, the current political power in play. And the current administration actually remains very unsettled with very high turnover. Not only that, we also note that the Trump administration has also failed in terms of their campaign promises. For example, they lost a vote to repeal and replace the Obamacare or the Affordable Care Act. There's currently a toned down version of the Mexican War. No tax reform has been proposed yet, not to mention infrastructure spending. And to add on to all these worries, there's actually an ongoing special counsel investigation on the links between Trump's 2016 presidential campaign with that of the Russian intervention. So worst case scenario for that to happen is actually for an impeachment to happen. So like I mentioned, picture tends to paint 1,000 words. This is the group of staff that was actually sworn in during in January 2000 after the inauguration of Donald Trump, and you can see those people that's actually being circled out, which are some of them you might be familiar with: Steve Bannon and Michael Flynn. These are all high-level posts, and they are no longer with the administration now. Like I mentioned, one way to look at whether how the current administration actually affects the dollar, we can look at Trump's job approval rating. So although it's just 8 months into his presidential term, obviously Trump has not met the expectation of the public, and you could see how it have cautiously affected the US dollar. So one thing we find very interesting as well is actually that the saving rates kind of lead the dollar index with about a 1 year. So the dollar actually lags the saving rates about there's a 1 year gap or 1 year lag in between. So we know that a combined saving of the household, business, and government seems to be a very reliable indicator of the determining the US dollar price, as the net saving rates of over the nominal GDP falls, so does the US dollar with a 1 year lag. Why is this so? Primarily is because economically saving, the propensity to save equals to the propensity of to invest, and investments affects business cycle. So once the investment starts to drop, when saving rates drop, investment drops. Business cycle is in a downward trend, and therefore the demand for dollar actually gets weaker. So all that's been said about dollar, what we feel is that this will have the most positive impact on gold prices. So we know, just a recap on where gold was at. Gold had a roller coaster ride in 2016. First half of the year, it actually gained about 30%, only for it to give back about 20% in the second half of the year. So that was quite painful for a lot of people. So as of 2017 today, there was two failed attempts to break through the $1,300 resistance level, but we have actually surpassed that in the most recent weeks. And of course, that begs the question on whether it's once again a good time to look at gold. In retrospect, actually our technical analysis has always been very bullish on gold. Currently our fundamental analysis as well has feel that we have always been bullish, and we feel that nothing has changed. What has changed in the most recent, or in the short run, actually has been just sentimental changes. Of course, the most compelling reasons why gold will rally higher is the negative correlation with USD. As we argued earlier on, with the weakening of US dollar, we will see that gold would perform positively. And from this chart, you can see that since January 2002, the correlation is negative. In fact, if we drag back history until 1974, the correlation with gold and the dollar is actually negative. The other reasons why we think that it's a good time to look at gold now and we are positive on gold is because gold is actually a very good inflationary hedge. You know, as dollar, like we mentioned, as dollar starts to weaken, dollar being the reserve currency will have a inflationary effect on global trades when it starts to weaken. And when that happens, and you could see that through the CPI data or the inflation data, during these inflationary periods, gold will be a good hedge to inflation. And in addition, we also feel that gold, which is part of the real assets, has never been this under-owned since history, or in the most recent history. What we did here was we used the real asset price over financial assets, which includes your S&P and your treasuries, and we note that if you look at the right-hand side of the chart, that the real assets is actually cheap compared to financial assets. So here we take a look at the sentiment of gold. How do we do that? We actually observe inflows and outflows from the gold-backed ETF. So what we see here is that there's been a positive net inflow back to gold-backed ETF, and in 2016 actually marks the first year of positive reversal from 3 years of negative outflow. So 2016 was the first year of positive inflows, and we expect 2017 to be on track for another year of positive inflows as investors flock back to gold. So not only has retail investors or institutional investors been buying gold, one of the other major buyer of gold we observed was actually from the central banks. You know, during this period of political monetary uncertainty or monetary questions has been raised over the stability of our current monetary system, and we see central banks have actually been accumulating gold as part of their foreign currency reserve. And this has been even more evident in the emerging markets. So at the table at the bottom of this slides, you can actually see that China, Russia, and a handful of the other emerging markets, including India as well as Mexico, has been accumulating gold for the past at least 10 years. So we also note that on aggregate in total, there has been a net purchase of gold by central bankers since 2009. I don't think that this is a coincidence after the GFC that happened in 2008. Prior to that, there was a net selling by the global central banks. Although earlier on we mentioned that gold has been performing well against the US dollar, we note that gold also has been performing well against a basket of the other globally traded currencies. Examples would be euro, sterling, yen, Swiss franc, Aussie dollar, Canadian dollar, Chinese yuan, Russian ruble, and the Indian rupee. So all these are actually the currencies that is traded most frequently with gold. And if you were to group these currencies together and equate them, and we compare gold against such a basket of currency, we note that gold, the strength of gold is not just reflecting the weakness of the dollar. In fact, gold is nearer to 2011 in this case, as you could see from the chart. So to conclude, we find that dollar will continue with its structural downtrend line. High level of public and private debt will keep a downward pressure on the US dollar. The confidence in dollar has also been greatly shaken by the behavior of President Trump and his administration. We believe that gold should reach its 2011 high of 1920 US dollar per ounce. Why is that so? We believe that the negative correlation of US dollar will continue to hold, and because of our belief that US dollar will continue structurally weaken, we believe that gold should improve. Positive sentiment from the net inflow, as we have observed, central bank buying, as well as the good performance of gold against the basket of its other currency. Just for your info, there's some recommended ETF here. If you believe the dollar bear story, there's actually the PowerShare DB US dollar index bear. And of course for gold is our usual GLD in US dollar. That's for our SGX market. Anyone that's trading the US market can go for the same ETF with the ticker code GLD. So with that, we come to the end of the presentation. If there's any questions, do feel free to type it into the question box. Okay, one question on gold mining stocks. Of course, the correlation is positive. If gold is expected to be bullish, we do expect gold miners to be positive as well. But with any stock, they are also subjected to the general sentiment of the equity markets. But our look on gold mining is positive. We don't have any coverage on gold mining stocks. Second question is how are the states of U.S. tax reform? Will Trump administration be able to pull through the tax reform in this current Congress? To put it shortly, there's a lot of agenda that's on the plate for Trump administration. One of it is actually the more urgent one is actually the debt ceiling negotiation. Of course, there's a lot of rumors saying that they're trying to tack on to some form of tax reform as well as infrastructure spending into this negotiation, especially from the conservative GOP or the Republican Party. Therefore, our view is that the tax reform will be hard, and if there is any, that will only happen somewhere next year.
Okay. We have issued an upgrade for DBS. So our new target price is 21.45 based on FY17 financial results. So as for, we have another question, which is any issues with MPL for the banks? No, as I mentioned, the MPLs are expected to be range bound and steady. So no lumpy issues coming out from the oil and gas. It's just maybe a little bit elevated net MPL formation and write-off. And so this put together is our main concern because the coverage ratio now is at the low. But considering the fact that the loan volume and rate dynamics are more positive now, there's higher chance that they can overcome this and patch it back by year end.
There's a question regarding trading central shows down for the gold spot. We do not control the cost for Trading Central. There's a question regarding outlook for STI and at least for the end of the year, and whether there's any correlation between the US dollar and the strength of STI. We have not done such specific study, but what we understand is that when the dollar weakens, actually it's actually positive for the emerging markets, so STI included. But we cannot say specifically. We have not done a study to say specifically that any form of dollar strengthening will affect the STI. But then on the other hand, we do have a separate technical view on the STI that would be up in the research tab on Poems. Do take a look. Our technical study shows us that if we believe that gold would hit 1920, silver should also recover to the 48 level. The estimated STI based on our current change of view in the banking sector remains about 3270 as per what we have reported during our monthly report. There's a question on venture. We are sorry that we do not have any coverage on that, but we are still bullish on the electronic sector. The question on the time frame for gold to hit the 1900 level. If the macro outlook doesn't change, we believe that gold should hit the 1900 marks within between the 1 to 3 years. If there's, please feel free to ask if there's any question regarding bank or dollar, gold.
Okay, our time frame for the bank's target price is 1 year, but we have been more conservative, so we use the financials for FY17. Be mindful that some of the brokers out there have based their target price on FY18's valuations. Okay, we have a question. Usually, a fourth quarter, how do Singapore banks do for profitability? There's no broad strokes to that. The only thing that is seasonal in the fourth quarter will be for example, the cards and the wealth management, because during the year end, the wealth investors, the consumer the high net worth investors will tend to go for holiday, and then there's not much activity. But cards, I'm sorry, pardon, cards will be higher because of holiday spending. So, but that is only one portion, so we can't really have any pattern to the quarter on quarter. Yeah, and we have another question is that does the positive view on the banking sector apply to companies like Sing Investment and Hong Leong Finance? So for Sing Investment, we have a coverage, and what is bringing them up for Sing Investment is a lot more straightforward, and that would be the loans, expanding the loans to deposit ratio to improve the net interest income. So, but these markets are, but Sing Investment and Hong Leong Finance, they are small players, and they have their niche markets. So, the positive drivers for the banks are slightly different. The dynamics are slightly different from Sing Investment. So, nonetheless, what we can really hope for is that as the benchmark rates move up, then of course Hong Leong Finance and Sing Investments could also price their loans higher. The only thing is that if let's say, for example, for Hong Leong Finance, probably we could allude to a higher composition of home loans, so that could, as we have mentioned earlier, the competition could be a lot stiffer for them. But for every other thing else, it would depend on the market forces. So we have a third question is based on FY18, what would be the target price for the SG banks? That will come in later. I'll do another piece to revise the price based on FY18 as we roll over to FY18. Thank you very much.
If there's no further questions, we'll end our webinar for the day. Do tune in next week